lighter vein, but saying that market fell today because today is International Polar Bear Day. Apparently it is, but you know, no real reason so far. There are also some reports that maybe with what's happening with the standoff between US and Iran, although talks are scheduled for next week, US personnel in Israel have been asked to leave. But you know, we're just trying to connect the dots. It's not as if global markets have sold off in any sharp way. The market, all this happened, the market was down 200 and it lost another 100 points in the last 10-15 minutes or so of trade. So that's basically it. 25,184, I think this is the final closing seconds, and we are down 312, 1.25%. Nifty Bank is down 1.25%. Mid cap index is down 1.25%. Small cap index, etc., will come up on your screen. So 2,700, 2,650 stocks are lower, and about 1,870 stocks are higher. And you know, as I was saying earlier, the 4 days did not make a difference, because still Monday, Tuesday, Wednesday, Thursday, it was 1 day up, 1 day down. And you looked at change from last Friday to Thursday, it would have been basically nothing, because every day got cancelled out by the next one. But today made a difference. And that's the reason why, if you look at the weekly change, which is Friday to Friday, we are down about 1.25% on the Nifty. By the way, the IT index managed a 50-point bounce. But guess what? For the week, the Nifty IT index is down another 4.5%. So absolutely damaging session, damaging week once again for the Nifty IT services index. And of course, I mean, lots of single stock movers as well. You know, some news related. IDFC First was down 12-13% for the week. You know, UPL was another big casualty. Markets did not like that deal which had happened. Tejas Networks over the last 2 days rallied about 30%. That turns up on the NSE 500 as one of the top gainers this week. So yeah, I mean, you know, single stocks, some action, but otherwise Friday, I mean, really turning that ranged trading that we've been in a more decisive way on the downside. We began this session and was saying that we are in a lower high, lower low kind of a framework. So perhaps the weight of evidence suggests that the market perhaps has got some downside, but you know, that showed up in a real way. 25,178, and we are done this Friday. It's a wrap on this edition of Closing Bell. Editors Roundtable will discuss what lies ahead in just a bit.
So in Podar, they don't do anything Bollywood and all.
कभी लेट होता है It doesn't move fast sometimes. Please send, Diana.
I don't think I'll come to access.
Start, chalo.
Yeah, I think economy.
The Dalal Street ends the week lower with all the major indices seeing cuts. The Nifty and the Sensex fall 2 percentage points each. The mid-cap and the Nifty Bank do mildly better but still lower. IT realty stocks were the top sectoral losers, fall 4% this week. Now, over the next 30 minutes, we'll decode the week on Dalal Street. We'll put the spotlight on the FIs and inflows, and is there hope of a turnaround in the FI outflows? Do they become inflows? Hello and welcome to another edition of Editors Roundtable. I am Reema Tendulkar. With me, our animation Nigel, and joining us here in the newsroom is Sanjay Parekh, founder and CIO, Soham Asset Managers. Hi guys, afternoon. If you'd seen the market till Thursday evening, the tally on the Nifty was absolutely flat. And then came Friday and the entire picture changed. 200-day moving average gone on the Nifty. And there was a big correction in the market, 300 points down.
Broadly, in fact, not only Nifty, Bank Nifty, broader markets, everything was down in today's market.
So Friday just changed
no
the picture
specific
completely.
reason, right? Yeah. In fact, the fact that today was an MSCI reval flows, it was supposed to be positive flows and all, but still, it's a very confusing market. You know, I talked to so many investors, HNI desk and all. I guess it's fairly lack of buying interest now. I mean, everybody seems so tired now. They've seen lower levels and then from there it goes further lower down. So I think it's a bit of sentiment as well, which is clearly playing out in the broader markets. Maybe it's a March factor as well. You see a lot of MTA book getting unwind. The retail and HNIs, sell their positions. So I guess that's playing out in the broader market. So hopefully by third week of March, things should settle out in terms of the adjustments as well for the March.
So one guest said that, on the channel, he said the DIIs, HNIs, the big family offices, there's just saturation in terms of buying, as you said, right? And the FIs are still seeing better growth opportunities elsewhere. We had so many big tech companies, for instance, reporting numbers, and they're all, Nvidia is growing 65, 70%. So then you are getting better earnings prospects outside.
That's right. Sanjay, let's find out how are you feeling about the markets. The broader pulse you were getting just a couple of weeks ago was that economy is doing better.
Yes.
So hopefully earnings as well pick up. And Q3 wasn't as bad. So Q4 will actually be better.
Yes.
But it's not matching up with what we're seeing in the market. FI flows were good as well. But the market is not moving up. That little fatigue is setting in, it seems so. How are you feeling?
I think first on the earnings. So the earnings Q3 for Nifty was like 8-9% growth, which was in line broadly. But the macro indicators were starting to look better.
True.
So if you take CV, we met Ashok Leyland said in certain segments the growth is 60% in certain segments.
Yeah.
Passenger vehicle, credit growth at this inflation rate.
Right.
14% is at this inflation rate. So it's pretty good.
Beautiful.
So we met ICICI, HDFC Bank. They're also talking of slow recovery. So, and you take cement, steel, things are slowly getting better.
Yes.
So this should logically show up in fourth quarter earnings growth rate, is what I feel. The behaviorally, yes, clearly within EMs, EM has done quite well from April 25, but all the money has gone to South Korea and Taiwan. It's an anti-AI trade which is on. And then we had this whole carnage of IT stocks, which would certainly have a rub-off effect on other markets.
Right.
So that's what I think is happening near term, but actually fundamentally things are getting better.
We have to talk a lot about IT, and I'm sure Reema will have a couple of questions on that front. And talking about Korea and Taiwan, we were talking about how a couple of stocks there have 30 to 40% of the index. But we'll get to that in just a bit.
Yes.
Just a quick question with regard to the economy looking better.
Yes.
If I look at your portfolio construct, I think 70-75% is in large cap.
Yes.
And around 20-22% is in mid as well as small caps.
Yes.
Now, if things start looking up on the economy front and if earnings come back, will you be tempted actually to put more money into the small and mid-cap names? Because they have got smashed out of shape and they could relatively do better. Your take?
Yeah, I think, see, it's bottom up. It's only, I was just talking to Nimesh and I was telling that now just that, when there are B2G companies where cycles are longer, you're not sure about the high leverage in mid caps and commodities, clearly no. But the rest of them, there would certainly throw up opportunities. So we are surely looking at it right now, but we are just saying that let's keep a margin of safety higher because somewhere somebody is redeeming, somebody has pressure, then why not take advantage of it? And just go slow on weightages. So our weightages that we'll put on the block will be more like slowly nimbling into mid and small cap, but there's clearly next 3 to 6 months you'll get opportunities.
Okay. So Sanjay, within large caps, what are your top bets? Where are you putting your incremental money to work? It's banks or commodities?
So our positioning has been domestic overweight, global underweight. It's been almost 3.5 years. IT has been a big underweight, which has helped us. Oil and gas is underweight. FMCG, we are zero. The rest, domestic discretionary, we are overweight. Financials, we are overweight. Neutral, banks just mild underweight, but NBFCs, we are overweight. Telecom, we are big overweight. Ports, logistics, we are overweight.
Sure.
So, and industrials, we are overweight. And cement, we are overweight.
So your portfolio has done well?
Luckily, we've been more like 21-22% on 1 year. But more than that, the longer term, we've done more like 20.5% compounding with 6% alpha.
But the question on, technology, we keep asking everyone, right? The conversation starts and ends with AI right now. And the thing is that over so many tech cycles, you've had companies which have gone bust because technology makes certain businesses unviable, like Kodak, BlackBerry, or whatever, BlackBerry also.
Okay.
The fear is right now you don't know which one is going to be the winner, which one is going to be the loser.
Absolutely.
When there is that kind of a question mark on who's going to survive, what do you do?
Yeah, the honest answer, as Howard Marks says, you should know what we don't know. While we did a lot of work on both the sides, whether it's benefiting IT services, and on the other side, what are these IT? 4 hyperscalers are going to spend $600 billion. They have contributed 50% of the GDP growth in US. So it's a pretty large spend they're doing, and the business models are evolving, according to me. At least, the revenue is what they're expecting. There are huge losses, and market shares are changing because there are new players coming in. So those, at least, it's not in our domain, but they will affect our companies like what Cloud did or to our IT services company. So there, at least, I would respect Mr. Nandan's presentation where he did say that we're looking at it as an opportunity more than, cannibalization. The opportunity is pretty large. And we just, as you said, we're just trying to understand the piece. There certainly will be tailwinds and headwinds. But for now, at least...
Have you been able to identify any stocks?
Yeah, so what we are seeing is, today Infosys is at an implied growth rate of 2%. TCS has an implied 10-year growth rate of 2%. Now, we have to ask questions that, is that so bad? So one broad comfort we are getting from all the meetings that we did recently in conferences that we don't see a downside from here, at least, with 6%, yield, FCF yield, and I don't know the tactical positioning of bouncing back, but at least we believe downside is limited. But having said that, we don't have the courage to increase our weight.
No, but Sanjay, you all have been spot on. with regard to allocation. Because on tech, I think you all have 4-5% weightage. The benchmark is at around 10-11%. On metals, you all are overweight. So kudos on that call, because I recall, asking you many months and not much was happening, and then boom, you made some good money. Now, since you're so underweight, and if you believe the downside is protected from here on, will you be looking to at least go more to a neutral stance rather than being underweight on these tech companies?
So I'll be honest, Nigel, it's very difficult of how will it shape up in terms of earnings. It's not easy. And I'm telling you, we met enough experts. Those who have invested in cloud, there was an authority invested 1 year back at $58 billion, and now it's $300 billion, right? And he put a $300 million check, and we met him. And you see that side, and you feel you will not touch IT. And then when you hear Nandan, you feel no, there is. And so it's a dilemma we are also going through. But at least we believe that downside from here is quite limited.
Argument a lot of people are saying that the downside is limited. But if there is no potential upside, and that happened with a lot of stocks, right? The blue chip of blue chip, HDFC Bank from 2020 to 24-25 has given zero returns. Blue chip of the blue chip, and they made tons of money in the last 20 years for a lot of investors. Is that going to be the case for IT as well? That it's flat and it just languishes for good 2-3 years with zero returns?
I mean, that's exactly why we're not trying to increase weight. That we're just trying to understand. Let's understand more. Let's get a better grip of it. I mean, I've looked at IT for 20 years, but I yet feel I need to still understand it better in this change, So while we got it right first time, but now it's more important to get it right again. So we're looking at persistence.
What would be the inflection point? Yeah, exactly. So what would be the inflection point for you to really turn positive, especially in mid-caps like Persistent, Coforge, or for that matter, Mastek, has now come to almost 10 times 1 year forward earnings, right?
Yeah,
so
I think one is, once we have a quarter, there will be a proper commentary. They've had several calls done, but one is that, and it will not get to know in 1 or 2 quarters, because this is not a problem of 1 or 2 quarters. It's about terminal growth rate, and after 2 years, as you also cover it. So I think one is engaging with them. That's the only way you understand. And then, then at a point, even markets will give you some signals, right? And then pick up that point.
Nimesh, one data actually that the market is telling us that the FIs finally turned buyers in the month of February.
Oh, absolutely. So that's a big data. In fact, it's not about India FIs turning positive in India. Since the beginning of the year, the flows have been quite strong in the emerging market as a basket. Only point was that India was not getting that fresh allocation. That has turned in the month of Feb. So month of Feb till now, the FIs are putting close to $2.5 billion into Indian equities. So it's been a remarkable change from what the stance has been. And I guess one of the reasons for that is the fact that India saw both the deals got done, right? The India-US deal got done, and even the EU deal got done. So from a tariff point of view, that big overhang for the global investors was not there. And I guess that was a key trigger for the flows to turn positive. So having said that, if you look at Y2D, just from January to now, FIs are still net sellers of close to $800 billion in the Indian equities. The biggest inflows have gone into Taiwan, which is $10 billion Y2D. Since January to now, Taiwan has seen $10 billion, and that's the reason why Taiwan has actually outperformed as well across all the markets. And South Korea, on the other end, has been the biggest outperformer of close to $7.5 billion of net outflows from the South Korean market. So that these two markets stands out, and India, of course, has turned a bit positive on that side. As I said, even if you look at the global markets, whether it's US, Japan, Europe, and EM has been seeing inflows for the last 3 to 4 weeks, and that's close to $3.7 billion. So net, EM was seeing inflows. Now, for the first time within EM, India started seeing inflows as well. And as I said, one of the triggers has been the EU and the US deal. I guess earnings have started picking up. Q4 is going to be strong, so that's also a bit of a kind of support for FIs to turn positive. And now what is happening is you're seeing that supply coming in from domestic, either DIs or retail investors, which are feeding into the FI buying. So I think that's also helping FIs to easily buy without any impact into some of those large cap names. So that typically says and turns up that FIs have turned net buyers for Indian markets.
Do you think this trend will sustain, this FI buying, or it's
a tough one? Because still EM, I really hope it happens, because domestics have been stabilizing it, but when you see an EM price earning, it's 13.5 times. And of course, concentrated by few bets, and historically the price earning have been 8 times in certain markets. So we will always be at a premium, which has been more like 50-55%. But it's important we get our growth back. And there is still not enough evidence of it. But if we get growth back...
And 15-16% is good enough, you think, if we get there?
I think for us, 15-16% on this base for the next 2 years, because the base is low. And next year when I see earnings, there can be real contributors. So you have a tailwind of both the trade deals. Then you have banks whose NIMs were under pressure. Interest rates almost has bottomed out. So we can be a big contributor to growth. Of course, IT could be a drag on earnings.
So Sanjay, this entire earnings argument, one of the argument is that the next year earnings are largely going to be driven by commodities.
Yes.
And in a typically commodity-driven earnings growth, you don't get the P.
Yeah.
So, because it's cyclical.
Yes.
So I think that's again going to be a challenge because IT will drag, a lot of, domestic cyclicals will drag because of rising commodity prices.
Yes.
Autos will drag a bit. So how do you map this? And also the fact that this, even in Q3, the strongest earnings came in the broader market. The small caps grew the biggest in terms of PAT growth and top line growth. So it makes more sense to get into small and mid cap now?
Yeah, I mean, first is, I agree that, the composition of index and evaluation and from growth, where is it coming is important. Yeah. And we do it simple, for us, growth at reasonable price, our portfolio price earning has to be lower. And it's luckily, we are 16 times. On mid and small cap, I again feel that, bottom up, now it's the time while we have a large cap bias, but one should certainly look at plays because there are certain plays and we are having a list ready where we want to buy at a price, but we want to have a higher margin of safety.
Okay, all right. Sanjay, request you to stay with us. We'll just slip into a short break, come back and we'll continue talking about the week gone by and how Sanjay views things going ahead. Stay tuned. Welcome back. You're tuned in to Editors Roundtable here on CNBC-TV18. Well, Sanjay, we're talking about a couple of sectors where you're underweight. Capital goods is a sector that you've been overweight.
Yeah.
You're like that space.
Yes.
Give us the thesis out there. You've got some unconventional calls as well in there, besides the big boy L&T.
Yeah.
You continue to like that even from here?
Yeah, I think, for the government to recover, the problem was not center or RBI also supportive, the states. So there, it's already in a base which is very low. Things will only get better. But there we are cautious that the working capital cycle, we don't want to get stuck up. So we have one Larsen & Toubro, which is a large conglomerate, which is a play on domestic and global, which has worked very well for us. And Then we have InterArc.
Bilcon.
Yeah, Bilcon is a small weight where I think there's still worries around working capital cycle. While we own it, but I'll still feel there are worries there. InterArc has a very short cycle, very, very efficient. There's a huge opportunity. A small player can get really large. Return ratios are good. The project gets over in 9 months. So that is what we like. So overall, and then utilities, we are overweight. So through transformers and JSW Energy is what we
Merchant power.
Sanjay, you spoke about, you've identified the list of stocks that you might look to buy. But just the learning of the last 1 year, I know some of the mid-cap names that you've been owning did well, and then it collapsed big time.
Absolutely.
What are the key learnings for you? What to watch out for in these kind of mid-cap companies, especially the companies which are too dependent on the government, the state governments for the release of money?
Yeah, I mean, it's always, while we would have made money, but, after the fall, I was telling my team that, we've gone wrong. While we were nimble to sell off, but anything on B2G, particularly state government, is a red flag. We will be very, very cautious now. That is one. Anyway, debt levels being high, we avoid. Commodities in mid-caps, we avoid. Promoter stakes being very low. Unlike the digital players, we are very uncomfortable. We want their skin in the game to be high. And then broadly, most of them we bought also, which were B2G. There was almost no debt. So we were on the right side of it, but working capital cycles are more important. The balance sheet is more important, is a learning for us.
The other part of accident came in the IPOs. Most of the IPOs came with a lot of frenzy, and it just fizzled out. They are down 60-70% from the peak highs. What's the call on IPOs now? I mean, are you avoiding IPOs?
No, we were lucky to have really not got into FOMO there. We avoided almost none of them. Very large, we didn't participate, and some of them you do get hit at times. But in hindsight today, we were comparing with our portfolios or the best 5 Nifty stocks. We do that today also. When I look at a mid-cap, I say, okay, this stock in large cap is going to give me 25% return. Can I get more? And that has helped us a lot, So we do that, and then we said, okay, why do we want to go there,
Go there, right.
So by and large, we didn't get hit by that.
What about defense? HAL, I think, is something that you like. And I think you'll own it as well. You could correct me on that. But of late, suddenly the news flow is not very, very good. The counter argument is they've got a great order book. Now we have to track execution. What is your view on it? It's 30-35% down from the top.
I'll be honest, we just sold HAL because, and it was just, we bought around current levels and we sold because we realized we don't have a visibility. And we had a very small weight to start with because we realized we were late. We're not early identifying HAL. We wanted to participate in the theme, but when we saw the G engines uncertainty and then AMCA approval for them not coming while it's a 10-year story, but we realized that it's better to accept and move out, and that's why we moved out of HAL.
This quick commerce stocks have corrected very sharply, both Eternal and Swiggy. Are they looking attractive?
Yeah, so, again, we used to look at very high growth rates and looking at 2030, getting into NPV, and yet our entry price was not coming to the level it was. Now, when we just see them, they look reasonable. But the only caveat is, and they themselves are telling, Zomato themselves are telling it's getting intense. The competition is very intense. Now, we need to hear to them as well. And this 80, 90, 100% in growth rate in quick commerce, if they don't sustain, then they are not cheap. So we are saying, we are watching them. We don't want to preempt. Let it grow for 100% for some more time, and it's okay.
But you generally get a good price or good news, right? You never get both of them hand in hand.
Right.
So right now, maybe the news will be bad with the kind of investments, but the price is good. But you're still not willing to buy.
Yeah, so here, when the management is saying, and they're very respectable, right? There's intense competition. There's cash burn by my peer. And at that point, we better listen to him than to get... And then, when you look at the numbers, you put at 30 numbers, get them 40 times multiple, and then get to NPV, then you get your entry price and you make 15% return. So at our framework, it still is helping. I mean, but having said that, I still feel that now they are really nearing the bottom, and somewhere it will become very attractive.
Any word on EMS companies? All are down 30-40% from the peak.